Picture the chest. Iron bands, 4 men to lift it, a guard riding alongside with one hand on his sword. That image is doing a lot of work, and almost none of it is true. Across 14th century Europe, the largest payments moved between cities without a single coin leaving the room it was stored in. The gold stayed home. What traveled was a sentence. The chest is not a neutral picture. It carries an accusation, and the accusation is about character. It says these were people who had not yet learned to abstract, who looked at a debt and could only think of a box, who solved problems with muscle and edged weapons because nothing subtler had occurred to them, backward, pre-rational. A civilization still doing its arithmetic with its hands. That version is not something you invented. It is what the museum diorama shows, what the film needs for its second act, what the textbook illustrator drew, because a strongbox is easy to draw and a ledger line is not. One of those images survives 6 centuries. The other one is the actual system. So the chest wins. Not because anyone lied, because it photographs better. And it photographs well enough that almost nobody stops on the obvious question. If you were a wool merchant in 14th century Tuscany, and every payment abroad required men, horses, weapons, and luck, how much business could you possibly have done in a year? The surviving account books answer that. And the answer is far more than that method allows. Here is the reframe. Early banking was not a transport industry. It was an information industry. That is the thesis. And the rest of this is the mechanism underneath it. Not a story about clever men in fur collars. A story about one physical fact that left them almost no room to do anything else. The fact is not complicated. Metal is heavy. It only gets from one city to another if a human body carries it down a road where other human beings are waiting. The metal has to be carried. Said out loud, that sounds like a limitation. By the end of this, you should be hearing it as something else, as a specification. Almost everything that looks to us like medieval commercial culture, the family firms, the guild oaths, the great international fairs, the church's ban on charging interest, was built either to satisfy that sentence or to route around it. So the order here is the constraint first, physically, in the mud, before it gets a name. Then the institutions it forced into existence, which are not the ones you would guess. Then the trade that never happened because of it. And then the part that turns the whole picture inside out, including the accusation we started with. One boundary before anything else, because it matters. This is Latin Europe, roughly the 13th through the 16th century, and most of the surviving evidence comes from Italian merchant houses and the Flemish, English, and Catalan markets they dealt with. Medieval Europe was not one economy. Practice in Genoa in 1300 is not practice in Lubeck in 1450. And where the record is thin, I will say so rather than smooth it over. Start with the sack. A merchant's coin is not money the way the number in your account is money. It is metal, and it is valued by what it weighs and how pure it is, not by what is stamped on the face. There are hundreds of coinages circulating in Latin Europe at any moment, minted by kings, bishops, dukes, and free cities. And a great many of them are clipped at the edges, worn thin, or quietly debased by the authority that issued them. So a payment is not counted, it is weighed. Sometimes it is assayed. The florin in your hand is a small ingot with a design on it. Now move it. The road from Tuscany to Flanders crosses the Apennines, then the Alps, then a succession of territories that do not recognize each other's law and do not particularly like each other. Every territorial boundary is a toll. Every river is a crossing fee. Every bridge belongs to somebody. None of those are hostile acts. They are simply how a lord converts geography into revenue, but they accumulate. And they accumulate on a cargo whose entire purpose is to be a fixed quantity of value that arrives intact. Then there is the escort. Armed men are not free. They are paid, and they are fed. And they and their horses eat every day the journey lasts. Whether the journey is going well or badly. Send twice as much silver and you need more men. And the men are also a risk, because they are the only people on the road who know exactly what is in the load and exactly how well it is guarded. A guard is a cost that walks beside the cargo and eats it. Add weather. Add a broken axle in a pass in November. Add the fact that if the load is taken, it is simply gone. That last one is the part that matters most, and it is the part the chest image completely hides. Coin carries no name. There is no serial number, no register, no owner recorded anywhere on the object. Silver taken from you on a road outside Bologna is not stolen silver by the time it reaches the next town. It is just silver. It is worth precisely the same to the man who took it as it was to you. Nothing can be frozen. Nothing can be recalled. Nothing can be proved. So here is the constraint, named at last, And it is worth being exact about it because everything downstream comes out of it. Metal is heavy, and it is anonymous, and it moves between cities only when a human body carries it along a road that other human beings can stand on. Not high transaction costs, not underdeveloped markets. A weight, a road, and a knife. The metal has to be carried. Because it has to be carried, certain things follow immediately. And none of them are matters of preference. The first is that trade at distance cannot be a transaction. It has to be a relationship. If you cannot cheaply send value to a stranger, then you cannot cheaply sell to a stranger either, because he cannot cheaply pay you. Any arrangement that survives has to rest on somebody whose behavior you can predict and, more importantly, whose behavior you can punish. Not through a court, because there is no court whose writ runs from Florence to Bruges. Through the only enforcement that crosses borders on its own. What other merchants will say about a man afterwards? A reputation travels for free, in both directions, and it travels faster than any cart. The second consequence is that value can only move at distance as an offset. This is the hinge of the entire system, so it is worth slowing down on. If moving metal is expensive, then the only affordable payment is a payment that cancels against another payment already heading the other way. English wool goes south into Italy. Italian cloth, silk and spices go north into England and Flanders. That means debts are constantly being created in both directions along the same corridor, and two debts pointing at each other do not need to be paid. They need to be matched, and then only the difference needs to exist as actual metal. That difference is small. That is the whole trick. And it is a trick that runs on arithmetic and bookkeeping rather than on carts. The third consequence is that the map of finance detaches from the map of trade. Money markets do not grow where goods are made. They grow where opposite-facing debts pile up thickest, because that is where the matching works best. A city can become a financial center without producing anything, purely by being the place where the largest number of obligations point in the largest number of directions. And the fourth consequence is that every serious merchant has to become an arithmetician, whether he wanted the job or not. With hundreds of coinages priced by metal content, there is never one price for anything. There is a price here and a price there, and the relationship between them shifts with the harvest, the mint, the war, and how much silver happens to be sitting in which city that season. A merchant who cannot hold two currencies in his head at once is not a merchant for very long. This is a profession where the mathematics is not an accessory. It is the load-bearing wall. None of that is a choice anybody made. It is what the constraint leaves standing, after everything else is ruled out. So what did they build to live with it? They built a piece of paper, and the paper is more sophisticated than most people expect. It is called a bill of exchange, and it requires 4 parties in 2 cities using 2 currencies. In one city, the deliverer hands over money, the taker receives it and writes the bill. In the other city, the payer, who is the taker's agent or partner, accepts the bill and pays out. The payee, who is the deliverer's man, collects. 4 people, 2 of whom never meet, tied together by one instrument. The wording is astonishingly plain. A bill surviving in the Datini archive from 1399 reads, in part, pay at usance by this first letter of exchange to Jacopo Gosio 625 écus, at 10 shillings Barcelones per écu, for the value received here. That is the sentence that moved the money. It is an instruction, not a container. Notice, before anything else, the phrase this first letter. It is not a flourish. Bills were commonly written out more than once, a first, a second, a third, identical in substance, and sent by separate couriers on separate days. Whichever arrived first was the one that paid. The others died on arrival. A system whose only moving part is a message has to assume messages get lost, and it did. Then notice the word usance. It means the customary interval before the bill comes due, and it is fixed by the city payer rather than negotiated fresh each time. From Northern Europe to the Italian cities, usance ran to 2 months from the date. From those northern cities to Barcelona, about a month from sight. From London to Bruges, Antwerp, or Amsterdam, roughly a month from the date of the bill. That delay is not a defect in the technology. The delay is the loan. Because look at what this single sheet is doing at once. It moves value between cities without moving metal. It converts one currency into another. It extends credit for the length of the usance. And it prices that credit inside the exchange rate, where it does not look like interest at all. That last one deserves its own moment. The church prohibited usury, and the prohibition was serious. But an exchange transaction was not legally a loan. Cambium non est mutuum. Exchange is not lending. So the return was built into the rates instead. A well-documented case from the Bruges and Barcelona markets in the winter of 1399 to 1400 runs like this. Money is delivered in Bruges against 600 écus. The bill goes out, comes due, and returns on a second bill at a different rate. And what comes back is 625 écus. 25 écus over 4 months. Annualized in the region of 12.5%. There is no interest anywhere in that transaction. There is only a decimal, quoted twice, in 2 cities, in 2 currencies. Work published in the Economic History Review in 2017, using the exchange rates preserved in the Datini papers between roughly 1,383 and 1,411, found this was not a loophole somebody occasionally exploited. The time value of money was priced into market exchange rates consistently, at implied rates comparable to what merchants earned on ordinary commercial lending. Then there is the second piece of built equipment. Somebody has to be standing at the other end. The Medici did not build a bank the way we picture a bank. They built a network of branches, and the dates read like a map of European trade being wired together. Venice by 1402, Bruges in 1439, London and Avignon in 1446, Milan in 1452 or 1453. Geneva moved to Lyon in 1464. Each branch is a partnership with local men, holding local currency, keeping local books, and carrying the family name as collateral. The technical term for that relationship, a bank in one country holding balances and executing instructions for a bank in another, is correspondent banking. We still call it that. The wiring diagram has not changed, only the wire has. And the third piece is the fair. The Champagne fairs ran on a cycle of 6 a year, and at the close of each one there were fixed days set aside for settlement. Merchants brought in what they were owed and what they owed, and the fair's own officials consolidated the whole tangle into a single net payment, made to or received from the fair. It could be settled in coin or in bills. What that means in practice is that a hall full of people carrying enormous mutual obligations could walk out square with almost no metal changing hands. That is a clearinghouse, not a metaphor for one. That is the mechanism, operating on paper and personal presence, several centuries before anybody had a word for it. It is worth separating these things, because they are constantly blurred together. A bill of exchange is not a deposit bank. A deposit bank holds your money and transfers it between accounts on its own books. Neither of those is a pawnbroker, who lends against a physical object. And none of the three are the same as actually shipping bullion, which continued to happen throughout. 4 different businesses, 4 different risk profiles, routinely collapsed into one word. One more separation. And this one is a correction rather than a distinction. The story you have probably heard credits the Knights Templar with inventing the letter of credit, complete with an encrypted code, so a pilgrim could deposit funds in Europe and draw them in the Holy Land. The Templars did handle deposits and transfers, and at scale, but the famous encrypted letter has almost nothing behind it. No original survives showing any such cipher, and the celebrated code appears to trace to much later tradition rather than to medieval practice. Which is not a dead end. It is the most useful thing in this section, because the origin story with the least surviving paper is the one everyone repeats, while the one with the most paper is almost unknown. That would be the archive found in 1870, in sacks jammed into a disused stairwell in a house in Prato. Roughly 150,000 letters, more than 500 account books and ledgers, some 300 partnership deeds, and 400 insurance policies, covering the years 1363 to 1410. One merchant's filing. It is the single richest record of how this system actually worked, and it survived by accident. Now the harder question, and the one that gets skipped. What did this system make impossible? Because a constraint is not just a fact about the world, it is a price, and somebody pays it. The bill of exchange solved distance beautifully for anyone already inside the network. It solved nothing at all for anyone outside it. Every element of the machine, the 4 parties, the correspondent branch, the accepted bill, the fair settlement, runs on names that other names will vouch for. Strip that away and there is no instrument left. There is just a piece of paper with writing on it. So the thing that became impossible in this world is commerce with a stranger at distance. Not difficult, structurally unavailable. There is no version of a 13th century transaction where 2 parties who know nothing about each other and share no acquaintance settle a payment across a border. Every single link in the chain has to be underwritten by somebody standing, and standing is not something you can acquire in an afternoon, which means the network was not just a payment system, it was a membership, and memberships are maintained, constantly, at a cost. A name did not simply exist in Bruges. Because it existed in Florence. It had to be introduced by somebody already trusted there, then tested on small business, then kept alive by a stream of correspondence reporting rates, arrivals, defaults, and rumors to people who would never meet you. That is what 150,000 letters in a single merchant's archive are actually for. They are not sentiment. They are the maintenance schedule on an asset that decays if you stop writing. A weaver in a town off the fair circuit could produce excellent cloth and still have no route to a distant buyer, because he had no route to a distant payment. To reach that buyer, he had to go through a merchant banker who had one, and the merchant banker set the rate. This is where the real cost lands, and it does not land where you would expect. It does not fall on the man who is cheated, because that story is easy to see and easy to tell. It falls on the person who cannot read the quote. Remember what the profit was made of, not a fee written at the bottom of a contract. A difference between two exchange rates, in two cities, one of which you are not standing in, on a date that has not arrived yet. To know whether you were being handled fairly, you needed to know the rate in the other market, and the direction it had been moving, and what the usance was worth in that season. The people who knew all three were the people quoting you the price. And the tidy version taught in textbooks is tidier than the ledgers. A study published in 2021, working through nearly 2,000 bills from the Borromée Bank's paired ledgers, Bruges in 1438 and London from 1436 to 1439, found that bills were used as loans, as speculative positions, and as security on contracts, and that maturities were frequently negotiated rather than run at the standard usance at all, which is a polite way of saying the terms varied with who you were. So the counterfactual is not a dramatic one, nothing burned down. It is simply that an enormous amount of trade never got attempted by people who never found out they were excluded because the door they would have needed did not have a handle on their side. Now the reversal. Go back to the accusation in the strongbox. Backward, pre-rational, muscle instead of thought. Take three things that get filed under medieval culture and put each one against the constraint. Start with the family firm, branches run by sons, nephews, cousins, in-laws. We read that as clannishness, or nepotism, or a society that had not yet discovered the professional manager. Look again. There is no court in Europe that will enforce a Florentine contract against a defaulting agent in Bruges. So what is the strongest binding available across a border? Kinship, and a shared name, and the fact that a man who steals from the firm cannot go home afterwards. That is not a cultural preference. That is the best contract enforcement technology on the market. Second, the oath and the merchant's word. The moral vocabulary is heavy, and it reads as quaint piety, but reputation was not decoration. It was collateral. It was, in fact, the only collateral that could travel 1,000 miles at no cost and arrive intact. A system where the cheapest thing to send is information will inevitably make its central asset out of information, and a reputation is exactly that, a compressed record of how somebody has behaved, transmissible by conversation. Third, the usury prohibition, which is usually presented as superstition holding economics back. It did not hold finance back. It shaped it. Every one of those bills exists in the form it does, partly because a return could be earned but not named. The prohibition did not stop the lending. It relocated the price into an exchange rate, which is precisely the column that an outsider cannot audit. A rule written to protect borrowers from visible interest helped bury the interest where borrowers could not see it, which brings back the original charge. They were not hauling boxes, because nothing subtler had occurred to them. They built a continental payment network out of paper, arithmetic, and reputation, and ran it for centuries. The reason it does not look like technology to us is that it is not made of metal or machinery. It is made of sentences, kept in order. Early banking was not a transport industry. It was an information industry. Now the necessary correction, because a constraint explains what was viable, not what anyone chose inside it. The same instrument, in the same decade, was used to move a widow's inheritance safely across a war zone and to roll a small debt from fair to fair until it had quietly doubled. Same paper, same rates, same law. The constraint set the boundary of what could be done. It did not reach inside and pick. Anyone who tells you the economics explains the whole thing has stopped one step short, and it is the interesting step. The metal has to be carried. Hear it now. Every institution in this story exists because that sentence is true, and to make sure as little metal as possible ever has to be. So what loosened it? Not virtue. A parameter. The first shift is that the paper detached from the place. The champagne fairs eventually lost the trade routes that made them, and kept functioning anyway, as an international clearinghouse for paper debts and credits, running their own commercial law under their own judges, outside the ordinary feudal order. The goods left, the ledger stayed. That is the moment finance becomes a separate industry rather than a service attached to a market. It went further than that. Dissatisfied with Lion, the Genoese set up a fair that had no fixed home at all, known as Bicenzone, which moved repeatedly, and from 1579 settled at Piacenza, a marketplace that had stopped needing a marketplace. Pure money, meeting on a schedule. Nobody became more honest along the way. The failure mode arrived with the system. The most famous case is the collapse of the great Florentine houses in the 1340s, after Edward III of England stopped paying. The chronicler Giovanni Villani reported the king owed 900,000 florins to the Bardi and 600,000 to the Peruzzi, and those numbers have been repeated for close to 7 centuries. Modern work in economic history disputes them hard, on the straightforward ground that the firms never had capital on anything like that scale to lend, and that roughly 2/3 of what was claimed represented unpaid promises of interest rather than principal actually advanced. That correction is not a footnote, it is the argument. The exposure that brought down the largest financial houses in Europe was not a mountain of missing silver, it was a mountain of unfulfilled sentences, which is exactly what the system was made of when it worked. And the last honesty, the bills never abolished the convoys. When the imbalance between two banking centers grew large enough, the exchange rate would move until it crossed what historians call the specie point, and shipping actual bullion, with all its guards and tolls and risk, became the cheaper option again. The quantity of gold and silver moving from Bruges to London, or Paris to Florence, did not fall. What changed is that the same metal now supported a volume of business out of all proportion to its weight. The chest was always real. It just stopped being the method and became the exception, which is roughly where we still are. When money crosses a border today, the thing that crosses is a message. The network most of those messages travel over connects more than 11,500 institutions across over 200 countries, and in 2025 it carried an average of just under 60 million messages a day. With a record above 68 million in a single day, it holds no money. It never has. It is a messaging system that banks agree to act on, and the settling is done the medieval way. The system that settles the world's foreign exchange trades nets the payments against each other before anyone funds anything, and the netting removes about 96% of the gross. On its record day, it settled $19.1 trillion, and the cash required to do it was $72 billion, 0.38%. Everything else canceled against something moving the other way. That is the settlement hall at the close of the fair, with better lighting. But name where the analogy breaks, because it breaks somewhere specific, and the difference is the whole of modern financial regulation. At the fair, there was no one standing in the middle. When a house failed, the loss did not stop. It propagated outward through everyone holding its paper, which is why one default in the 1340s could take down several of the largest firms in Europe at once. Modern clearing added a party that guarantees both sides and holds capital against the possibility that one of them cannot pay. We did not invent netting. Netting is medieval. What we invented was somebody to stand behind it. So, two things at once, and both are true. The constraint was real. Metal was heavy, roads were dangerous, and no amount of ingenuity was going to change either fact. Everything in this story was built inside a box nobody could open. And inside that box, people still chose. The same bill carried honest trade and quiet extortion. The same network that let a merchant in one country pay a supplier in another also decided, without ever announcing it, who was allowed to trade at all. The constraint set the walls. It did not write on them, which is why the origin story we tell is backwards. Banking did not begin with a vault, or a hoard, or anyone guarding anything. It began with two men in two cities, agreeing that a sentence was worth as much as silver, and then behaving as though it were, for long enough that it became true. It was never made of metal. It was made of sentences. That is the price of weight. The next constraint is stranger, and it costs more. What it takes to make a promise outlive the man who made it.